My name is Tony Crawford, and I am pleased to present a review of my research of Professor John Chant's Canadian Government 2009 ABCP Crisis in Canada report for a doctoral degree. The dissertation provides a tax revenue loss business case for a basic banking reform G20 reverse onus rule that I discussed with Canadian Minister of Finance, the Honourable James Flaherty. The following two-part presentation illustrates first-wave Ponzi bank loan dependent asset-backed commercial paper and second-wave naked credit default swaps as causal factors of sovereign debt. Part 1 analyzes the monetization of toxic loans through taxation systems behind the largest bankruptcy of a financial conduit in Canadian history. Part 2 refers to Canadian New Democratic Party leaders signing Petition 44 for consumer protection in case of investment banking predatory lending practices in financial markets. Let me thank the Tax Justice Network Research Workshop for the opportunity to present an academic study of the 2009 ABCP Crisis in Canada report by Professor John Chant for the expert panel on securities regulation in response to the largest $32 billion bankruptcy of an asset-backed commercial paper, ABCP, financial conduit in Canadian history. The research objective is to show monetizing toxic loans through taxation systems is a causal factor of sovereign debt in the global credit crunch. The title, Capitalism Without Capital, was coined by former Prime Minister Gordon Brown as the cause of the global credit crunch in the United Kingdom in his book After the Crash. It implies profiteering from other means, that is the antithesis of the research objective, to define a policy for taxpayer protection and greater stability in financial markets. The issue of unregulated ABCP third-party notes in this discussion paper is a Canadian case for banking reform in Petition 44, sponsored by the New Democratic Party in parliamentary debate. Professor Chant defines structured investment vehicles, SIV, as having the sole purpose of holding assets and issuing claims against them. He finds ABCP is designed to produce cash flow from asset holdings that with disclosure investors would be better able to recognize ABCP as dangerous to their financial health. The expert panel on securities considers ABCP dealers misunderstood the nature of the products they sold, and the government invites aggrieved investors to review the report, which recommends education to prevent another collapse in financial markets.
We are taking an important first step toward a new regulatory regime.
Yesterday, Federal Finance Minister Jim Flaherty encouraged critics to read the panel's report with an open mind.
To think about the need for consumer protection, to think about what has been happening in the world, and to take a Canadian approach.
In the meantime, Flaherty doesn't want to say whether he expects that approach to include a court fight.
The research data is Bank of Montreal, BMO, investment loan histories that sold allied schemes. The research method is to construct Professor Chant's ABCP acquire to distribute business model, including investor accreditation failures that appear as process and/or information gaps in the off-site loans closings computer support system. Financial stability is a global issue, and the Governor of the Bank of England worries that banks profit from gullible clients, while Lord Turner seeks eternal vigilance over the complex structure of banks that rather than providing social benefits, he warns they reflect objectives of tax avoidance and regulatory arbitrage. This chart illustrates document and information flow, with Allied as the agent for the bank, selling investments in the lower right, and BMO selling codependent loans in the top left, for ABCP investors to claim income tax credits in the top right. Allied Properties Real Estate Investment Trusts, Allied REITs, sold in BMO capital markets, promote the same properties Allied sold to investors in the 1980s with ABCP step transaction loans. A BMO project statement identifies Allied as the agent for the bank to acquire and own income-producing commercial real estate in these 1987 land registry records. The Allied tax-sheltered Front Street property is promoted that investors receive rental income that is pre-consigned as an encumbrance to repay the mortgage. Professor Chen generalizes ABCP as mortgages resold as investments. The case study scenario has a $15 million debt load on a $5 million property plus a $5 million mortgage paid from rent. BMO loan sales generated some 15% interest charges on $10 million that required the property to quadruple in value in 10 years for investors to break even. Investors saved tax credits into undisclosed bank loans and financial ruin.
These syndication deals start out by looking for individuals that fit a classification of a sophisticated investor. In other words, somebody that has a reasonable amount of equity and has the ability to carry debt. This was quite a large syndication deal. There was at one time listed 308 limited partners throughout Canada and the United States. The bank's view is this is a deal that's based upon the individual's ability to pay back a debt. The misconception, or I guess the misgivings or the misrepresentation, really comes from the promoter's point of view, where they are saying that the bank is on side, when in fact the bank really isn't on side. The bank is really there to make a loan.
BMO off-site loans closings can be illustrated as an ABCP, acquire to distribute business model, in a simplified view of a front office selling investments tied to a back office selling loans that qualify and quantify sales. The rent that pays the Allied mortgage is the heart of the business model. Allied, as the agent for the bank, pre-qualifies sales in the front office for bank accreditation in the back office. The step transaction starts when people sign agreements that depend on earnings to be tax credit worthy to purchase tax-sheltered deals that include pre-executed loans that depend on personal creditworthinesses as follows. Allied refers packages with signed but otherwise blank contracts and incomplete promissory notes with agency waivers to BMO in the back office. BMO rubber stamps its demand notes for investment loans that include referral fees paid to Allied sales reps who witness borrowers' signatures and fill out promissory notes according to credit decision amounts that close sales. The deal closes with monies paid to Allied to paper investor notes as mortgage derivative credit default swaps, insurance money, for the ABCP product to function as a tax shelter scheme. ABCP sets up two financial conduits. BMO reports pre-executed loans with mortgage terms and conditions that investors claim for tax credits, while Allied collects and reports rent that pays down the mortgage. Claims for rent losses as personal expenses monetizes non-bank notes for cash through taxation systems that reduces income tax paid to the government. Step transactions, also known as sham transactions, are designed for each step to be independent and legally correct to attest no knowledge and no wrongdoing when back-office banks sell loans handled by their agents in front offices selling mortgages as tax-sheltered investments that can't be sold or function without them. The following loan documents appear to be designed and packaged to be misleading for investors to sign with no knowledge of a bank in the background for Allied to process ABCP step transaction loans. Allied sales packages bundle a BMO agency waiver and affidavit of subscribing witness in steps 2 and 3 that Allied notarized bank-paid witnessing of signatures for contingent tied loans in step 4. Step 5 is an Allied Statement of Affairs BMO loan application for investor accreditation for money to invest in Allied. BMO rubber stamps and fills out signed demand notes with credit decision amounts in steps 6 and 7 that quantifies the number of investments sold in step 8. Steps 9 and 10 close transactions that started as tax benefit assessments in step 1. BMO advances loan funds to Allied that signs investors' notes in acceptance of money thereof witnessed by Allied sales reps that witnessed investors' signatures for BMO loans. Papered notes function as insurance money to repay off-the-balance sheet mortgages in case of default. This Allied investor note case study mortgage derivative credit default swap format with so-called for value received to investors guarantees Allied mortgages. The principal amount in lawful currency of Canada pays interest in like money for as long as it exists as an asset in financial markets. It becomes a toxic loan when it fails to perform with the mortgage in default. Allied ABCP third-party notes are legally binding to collect when Allied signs an acceptance and sales reps witness makers that with knowledge would not have signed for a mortgage debt twice over and will sign neither again to renew in default. The problem is exacerbated when commercial paper that performs like insurance money is repackaged and resold to spread the inevitable risk of non-renewable derivatives across markets like a Ponzi scheme. In a Ponzi scheme, the mortgages are resold with rent encumbrances as investments that subscribers guarantee as ABCP makers that depend on bank accreditation for pre-executed loans that require notarized witness of signatures to open bank accounts that perform like mortgages to claim tax credits. The scheme sets up loan-dependent ABCP non-bank notes that collect and report interest charges to claim rent losses for income tax credits until they become toxic loans and fail to perform in default. When ABCP pays out underlying mortgages in maturity or default, the commercial paper reverts to unsecured, non-performing toxic loans that bankrupt ABCP financial conduits that otherwise provide cash flow numbers as money in financial markets. Canadian taxpayers that paid non-bank note interest charges to makers saving personal income tax credits in so-called RRSPs also pay cumulative principal owed to ABCP third-party note holders at some $32 billion spent from public wealth. Tax credit savers that paid interest charges on unnumbered, undisclosed bank loans selling ABCP that were never advised with client statements and never appeared in personal credit ratings also pay principal due to demand notes in the government report at some $85 billion paid from private wealth. The concept is only plausible in the veracity of debt collectors in the largest bankruptcy of a financial conduit in Canadian history. A pre-planned structural deficit sovereign debt business model that dumps fake money in financial markets as toxic loans in the bottom line doesn't end with payment when the economy itself is at risk to endless refinancing. Unsustainable debt unfairly burdened on taxpayers requires government intervention to reverse the trend. There can be no doubt the case study lending technology has systemic debt wired in its design. The main concern is capitalism without capital, from the monetization of toxic loans through taxation systems that still continues without regulation. Taxpayers have a fundamental right to Basel III rules for transparency and disclosure by the banks, with increased capital reserves to absorb shadow banking losses, and the separation of retail and investment banking operations to protect consumers. The main recommendation from the case study research is a basic reverse onus rule that lenders must prove identity validation and financial due diligence before transacting loans to collect. Also, notifications to borrowers to confirm investment-tied loan decisions before closings. And from a transparency point of view, send copies of retail bank demand notes and investment non-bank notes to their makers and credit rating agencies. And finally, should ABCP holders return cancelled ABCP non-bank notes to ABC makers that pay out ABCP mortgages in default, or governments that bail out ABCP holders at taxpayers' expense? I hope the presentation was informative, and I appreciate Tax Justice Network and your interest in the question. In closing, I am grateful to friends in politics who support the Petition 44 reverse onus rule as a proactive approach to stem the tide of ABCP notes that bankrupt financial conduits. The alternative is sovereign debt with tax increases and social service cutbacks to pay for loans to refinance spent commercial paper that failed to roll over with mortgages in default. Thank you.